Hello and welcome back to Trading Your Job with Matt. Today's video comes from a viewer comment, and the request was to review two ETFs, and they're both around volatility, shorting volatility to be more specific. And the ticker symbols of those are SVIX and SVXY. And the comment that this person made was that compared to the Qs, they look unstoppable, and they're actually outperforming the Qs, which are having a really good year-to-date performance. So we'll be looking at that today. In my research prep, though, for both of these, I noticed something really interesting in the prospectus, and you don't hear that phrase often. The phrase says an investor in the fund could potentially lose the full principal value of their investment within a single day or overnight. And that led me to think, well, has that ever happened before? Because usually words like those would mean that that's happened. And so the answer is yes. In 2018, there was something called Volmageddon. A short-term VIX ETF blew up overnight. So we'll just be looking at what happened there, and also if this is something that you should consider adding, or if maybe there are better ways to short volatility that don't leave you as exposed to those risks. If that sounds interesting, go ahead and stick around. If you're not already subscribed, please consider subscribing. It's free. You can change your mind anytime. I put out content on all types of financial topics, including ETF reviews like this one. If you have any requests, please leave them in the comments and I will do my best to get to them. So I started with Portfolio Visualizer just to see visually how much these have outperformed the Qs. And the answer is quite a lot. The Qs are in the green, and then you have SVIX in blue. You can see that's been the most volatile. It actually was down the most going into October 2022 and is now up the highest. So the comment was right on. It is definitely outperforming and seems unstoppable. And then the red line is SVXY. That is another short-term futures contract. It's 0.5x though, not 1x. And then you have SVOL, which I've done a review on before. They use options and futures contracts to short volatility. So the three lines at the top definitely outperforming, straight up buying the Qs, over the since April of 2022. And the data is constrained to April 2022 because that's when SVIX inception was around then. So after seeing that the outperformance really started in October of 2022, I decided to pull up the VIX and just see, what was going on in the markets around then. You can see that on the weekly time frame here back in 2022, we were hitting the upper Bollinger Band, and I know a lot of people don't like to do technical analysis of the VIX, but it doesn't hurt anything in this case. That signal means that it's overextended. It's the same thing down here on the Channel Commodity Index. It's overextended, and you can see that there was a massive sell-off. Well, since you're shorting the VIX, when it goes down, your fund goes up, and that's great news for you. But you can see that over time, those sell-offs have led to really big spikes. And back in 2020, got a huge spike. Now this SVIX was not in existence then, but that is the type of move that could really decimate the fund, where it says you can lose, all of your value overnight. That's similar to what happened in 2018. And 2018, there was something called Volmageddon. The ETF that blew up in 2018 was ticker symbol XIV, and it's basically the same concept as SVIX. And so XIV was a Velocity Shares daily inverse VIX short-term ETN. Had the same strategy. It was created to give traders an opportunity to bet against a rise in volatility. So the calmer the markets, like we're seeing now, the more profitable the trade. But when there's a lot of risks looming, that creates, a big issue in terms of your risk. When there's a big drop in volatility, that can sometimes signal that there's going to also be a big uptick in volatility. And so everything was great until it dropped 90% after hours, and you had no chance to get out at all. Stop loss wouldn't have helped you because it was after hours. So Volmageddon wiped out about $2 billion in assets overnight, and it was due to a doubling of the VIX, which made these ETFs insolvent overnight. And this article from MarketWatch, published in February of this year, is warning that these are back out on the market, and there's another, and that risk is in play again. So it's not that I don't want to review the ETFs, both of them, but I think that those risks of being able to lose your money, 100% of it overnight, should stop us right there in terms of wanting to buy this, because there are other methods to short volatility. So if you want to short volatility, the most safe way to accomplish what you want to do when you identify periods of high volatility, you want to then buy puts and long-term puts that bet on the volatility going down. Because when you buy an option, the most that you're going to lose is your premium. And so, you're not going to lose 100% of your portfolio. You could lose 100% of that contract, but you would know that risk going in advance, and you wouldn't have to, worry every day that all of a sudden there was going to be some news overnight that took your account to zero. And I know that the market's really just shrugged off all kinds of news in the last few months, and we just continue upward. The Fed, who was using a fire hose of liquidity before, has now slowed that to a trickle, at least so they say, and it hasn't really had an impact on the markets. We've had wars, we've had bank failures, we've had all kinds of things that in other times, would have brought the market down. But right now, none of those things have. So if you think that the VIX is going to single digits, and I've seen a lot of people, thinking that, then there's room to short here. And you can just buy some puts on the VIX. It's pretty easy to do. And you just go buy your puts, and then you don't have to worry about waking up to $0, overnight. At least, through buying shares. If you were to go all in on this or buy a significant amount of shares, you'd really be exposing yourself to a lot of risk. And I just don't want you to put yourself in that kind of position when there are other options, using options to do that. I hope that makes sense, and I hope you understand why I didn't dive too far into how they operate, because those significant risks would tell me not to buy it. If you disagree, please leave a comment. Let me know why. I want to thank you for joining me. If you have any comments, questions, if you own these and you want to tell me why you think I'm wrong about, the risks involved, please let me know why. I'd like to hear from you, and I'd consider other perspectives. I always read the comments, so please make sure that they hurt my feelings if they're mean. Got more videos coming soon. Till next time.